$52,000. That's roughly what the age pension pays a couple each year in Australia right now. It's not nothing, but it's not exactly the retirement most people spent 40 years working toward either. So when people talk about building a dividend income stream that replaces a real salary, something around $100,000 a year, they're not being greedy. They're trying to build genuine financial independence. The question is what that actually takes in Australia. With Australian tax rules, Australian yields, and Australian market conditions, not some theoretical American example with a 4% withdrawal rate and a Roth IRA. The real numbers, in the real system, you're actually living inside. Let's get into it. What yield are you actually working with? The starting point for any dividend income calculation is yield. And in Australia, yield has a dimension that almost no other market in the world offers at the same scale: franking credits. When an Australian company pays a fully franked dividend, it's already paid 30% company tax on those profits before they reach you. The franking credit attached to that dividend represents your share of the tax already paid. For a retiree with a low taxable income, the ATO will refund those credits in cash. That's not a theoretical benefit. That's money deposited into your bank account after tax time. The ASX 200 currently sits on a grossed up yield, headline dividend plus the value of attached franking credits, of roughly 4 to 4.5%. That's the broad market average. But if you tilt toward higher yield options, the numbers shift. Vanguard's High Yield Australian Shares ETF VHY is currently running a trailing yield of around 5.4%, with recent distributions carrying approximately 88% franking. That's a meaningful income tilt, still diversified across over 50 companies, and with most of that income arriving with significant tax already attached. So at a practical working yield of around 5%, grossed up, including franking, a $2 million portfolio generates $100,000 a year in income. That is the headline number. But how hard that $100,000 works for you depends almost entirely on where you hold it. Structure is where the real money is made or lost. This is the part most conversations about dividend income skip straight past. And it's arguably the most important variable in the whole equation. If you're holding dividend shares in your own name outside of superannuation and you're earning $120,000 from your job, every dollar of dividend income on top of that sits in the 39% tax bracket, including the Medicare levy. A $5,000 fully franked dividend from a Big Four bank comes with a $2,143 franking credit attached. You declare $7,143 as income. You get a $2,143 credit applied, but at your marginal rate, you'll still owe an additional top-up of around $640. It's not catastrophic, but it's a drag. And that drag compounds across an entire portfolio. Now put that same portfolio inside superannuation in the accumulation phase. Investment income, dividends, distributions, capital gains is taxed at 15%. That franking credit doesn't disappear. In many cases, it wipes out a chunk of the tax owed entirely, and you keep far more of the income. Now move into retirement and shift your super into pension phase. Under the transfer balance cap, which rises to $2.1 million from July 2026, you can hold up to that amount in an account-based pension where all earnings, every dollar of dividends, every distribution, every capital gain, that was taxed at zero. Nothing. The franking credits on your fully franked ASX shares become refundable in full. Your effective tax rate on dividend income inside a pension phase super account is genuinely zero. That means a $2 million super portfolio in pension phase at a 5% grossed up yield is producing $100,000 a year and keeping every cent of it. You don't need to gross up for tax. You don't need to factor in a marginal rate drag. That is a structurally powerful position, and it's available to ordinary Australians who plan for it deliberately. What if you want income before you can touch your super? Preservation age in Australia sits at 60 for most people born after 1964. If you want to live off dividend income before that, you're working with a portfolio outside super, and the tax picture is less favorable. That doesn't mean it's a bad strategy. It means you need to account for it honestly. The approach that works best here is running two portfolios in parallel, one inside super, compounding in a low tax environment, and building toward a pension phase drawdown, one outside super in your own name or through a family trust if the circumstances warrant it, generating accessible income before preservation age. The outside portfolio takes the tax hit. The inside portfolio builds efficiency over time. Together, they give you both flexibility and compounding power. A broad Australian ETF like BetaShares, A200, has delivered annualized total returns of roughly 9.8% since inception, with recent quarterly distributions carrying around 85% franking. Combine that core position with VHY for an income tilt, add some global equity exposure through VGS or IVV to reduce your concentration in Australian banks and miners, and you've got a portfolio that's diversified, income producing, and not catastrophically exposed to any single sector downturn. Dividends can be cut. Plan for it. During the early months of COVID in 2020, Australian banks slashed their dividends at the direction of APRA, which told them to preserve capital rather than pay out to shareholders. Westpac's dividend dropped by roughly 50%. ANZ deferred theirs entirely. For someone living off bank dividends as their primary income source, that was a genuine shock. This isn't a reason to avoid dividend investing. It's a reason to build a portfolio that doesn't depend on any single sector maintaining its payout. Mining company dividends fluctuate with commodity prices. Bank dividends move with regulatory capital requirements and credit cycles. Property trusts adjust distributions when debt costs rise. The answer isn't to avoid these sectors. They're among the highest yielding parts of the ASX. The answer is diversification across sectors, across a number of individual holdings, and with a cash buffer that means you're never forced to sell shares at the wrong time just to cover living expenses. 6 to 12 months of living expenses held in a high interest savings account. Right now, you can find rates around 4.5% to 5% at institutions like ING, Macquarie, or UBank. Means a dividend cut or a market pullback doesn't force your hand. You draw from the buffer while the portfolio recovers. That buffer is the mechanical difference between a dividend strategy that survives a downturn and one that doesn't. The honest roadmap. The first milestone is getting $100,000 invested. That's where compounding starts to become visible and the distributions start to feel real rather than theoretical. Reinvest every distribution through a dividend reinvestment plan at that stage. Let the snowball build before you start taking income. From there, it's about consistent contributions, diversification across quality ASX ETFs and individual dividend-paying companies, and maintaining your super contributions to maximize what's growing in the tax-efficient environment. The concessional contribution cap sits at $30,000 per year right now, rising to $32,500 from July 2026. Salary, sacrificing to that cap where your income allows it, is one of the highest leverage moves available to an Australian building toward dividend independence. As you approach the final stretch, within 5 to 10 years of retirement age, the focus shifts to getting as much into pension phase super as possible before you flip the switch. The combination of a large tax-free portfolio inside super and a diversified income-generating portfolio outside super gives you income flexibility, tax efficiency, and resilience. To reliably produce $100,000 a year in dividend income in Australia, the realistic portfolio size at a sustainable 5% grossed up yield is $2 million. In pension phase super with zero tax on earnings, you might get there at slightly lower capital because you're keeping more of the income. Outside super at higher marginal rates, you need more capital to net the same after-tax result. The number responds to your structure, your age, your tax position, and the quality of what you own. But the principle underneath all of it is simple. Income that shows up without you selling anything. income that has franking credits attached, income that compounds if you let it, and a structure that keeps as much of it as legally possible out of the hands of the ATO. That's the goal. Build toward it deliberately, and the maths will work in your favor. If this helped you think more clearly about what dividend income actually requires in Australia, hit the like button and subscribe. There's a lot more straight-talking Australian finance content coming. I'll see you in the next one.